Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel. Interest rates can be a funny thing. It's been interesting, interest rates have, over the past several years, because we went from an environment where interest rates were essentially zero, at least the short-term interest rates were essentially zero, for a very long period of time, much longer than any time in history that I'm aware of. Maybe there was something long time ago where interest rates were zero for a while, but I doubt it. It's an unusual deal that we had for quite a long time. That changed in 2022 when the Federal Reserve rapidly started increasing interest rates during that year to get us up to more of a historical normal level. Now, some will still say it's restrictive, and they might be right. Restrictive being interest rates are too high. I don't know that there's any perfect amount per se, but at this level, it's more in line with where it has been historically. Now, that causes a lot of consternation when people see interest rates go up, and there can be a lot of panic. Obviously, we have a lot of national debt, and when you see interest rates rise, that just increases the amount of interest that we have to pay on that debt, which is a problem, and we'll see how that gets handled in the future. But in the short term, a lot of times people see interest rates go up, even if it's going from a 10-year treasury of 4.5% to 5%. They'll see that change and they'll start to freak out a little bit. But the point is that that's not really an emergency. Maybe that has some longer term impacts, and that could be a valid argument. But it's not really any reason to panic whatsoever. In fact, it was actually kind of weird when we had close to zero interest rates, because what does that mean? If the economy turns south, there weren't a whole lot of tools to help stimulate. We could do some government spending. The Federal Reserve could buy back longer term bonds, which they did for a little while. So there's other things they can do, but when your interest rates are close to zero, you can't really cut interest rates to help a slowing economy. So that was really kind of a weird time where there's actually a little bit more risk involved because interest rates were lower. But when we look at retirement investing, how does rising interest rates impact what we need to do from an investment perspective? So let's first take a look at bonds, and then we'll take a look at stocks. Well, on bonds, when interest rates go up, bond funds tend to lose value. And that's going to depend on what type of bond fund, what the duration is, things like that. But in general, when interest rates go up, the value of bonds goes down. When you think about this conceptually, it makes sense. If I'm holding a bond that pays 5%, all of a sudden now you can buy a U.S. Treasury at 5.5%, whereas let's say before it used to be the U.S. Treasury was paying out 4%. And I had my bond at 5%, and now the U.S. Treasury is paying out 5.5%. So it's paying out a higher interest rate than my 5% bond. Well, therefore, my bond that I have is worth less because interest rates have gone up, and now somebody else can go buy a new bond with a higher interest rate payout. So that's the general concept of, as interest rates go up, the value of bonds goes down. Again, that's going to also depend on duration. That shift in interest rates impacts longer term bonds more than it does shorter term bonds. We're not going to get into all the details on that. Just understand that in general, when interest rates go up, bonds go down. Why is this important in retirement planning? I advocate for the use of individual bonds instead of bond funds. Now, you can still use short-term bond funds, and we do use that because they're not going to be as impacted by those changes in interest rates. And a lot of times the short-term bond funds tend to be in really high quality bonds. So you're not, again, going to see much change in value of those funds with changes in interest rates. So if interest rates go up, you're not getting dinged as much if you're in a high quality short-term bond fund. So a lot of times if we need cash for the next year, maybe 2 years, we can use a short-term bond fund for that. Otherwise, I advocate for using individual bonds or individual structured notes because they have a set maturity. So if we're working with somebody and we say, we know you need this much income 3 years from now to live on for that year, we want to make sure that we match up a maturity amount and date specific to that income need 3 years from now. We don't want to be in a bond that maybe it'll be more, maybe it'll be less. I don't know. If we're in a bond fund, we don't know exactly what that value is going to be. If we're in an individual bond, we can look at it and say, okay, this bond is going to pay out $50,000 3 years from now, and that's going to cover our income for the next X number of months. And therefore, as interest rates change, yes, that bond will fluctuate in value a little bit, but we know that at the end, it has a maturity value on a set date. So in the meantime, we are collecting interest payments and we're going to get a predetermined amount on a predetermined date in the future, regardless of however it fluctuates in between now and when it matures. We don't care. It looks weird on an account statement. Maybe the value has gone down, but that's all temporary because we know exactly what the maturity value is. So for retirement planning, that is why we advocate for individual bonds, individual structured notes, things that have a set maturity where we know what we're going to get back on that date, regardless of what the short-term fluctuations are. Versus if you're in a bond fund, who knows? You could actually wind up better. If interest rates go down, that bond fund could go up, which is great. We just don't know that. We don't want to play with that. We want to know that our income for the next 5 years is set. We've got that covered no matter what happens with interest rates because we use individual bonds, individual structured notes, CDs, and maybe short-term bond funds. Now, what do changes in interest rates mean for stocks? Well, the interesting thing is that it's actually a negative for stocks generally, but it doesn't have to be. It's not, again, it's not an emergency. It's not like, oh my gosh, this is just going to always be terrible for stocks. A lot of times it's a short-term impact, especially in stocks that pay out a higher dividend, because now those stocks have a little bit more competition from bonds that have higher interest rates. So again, if a bond is going from, if you're 10 years going from 4 to 5.5%, and that happens over, the course of a year, let's say, well, now you might have a dividend stock paying out 4%. Well, as that interest rate of the bonds goes up, your dividends, they got some competition because you now have an alternative. You could, instead of be owning the stock for a dividend, you could go be buying that bond, which is paying out a higher percentage. It doesn't make it wrong to own that stock because the value of the stock long term could continue to go up. But it's just important to understand that now that dividend has some competition in the form of a higher interest rate from a bond where that bond might hold less risk. So it's not necessarily a good or bad thing. It's just a matter of understanding your time frame and understanding that higher interest rate might decrease the value of that stock that pays out a dividend, at least in the short term. But if you're a long-term holder of a consistent, high-quality company, don't freak out about it. You're still going to be getting that dividend. The company can still grow and that stock price can go up. So your total return could still be higher than that bond. It's just you have a little bit more risk in the stock than you do in the bond. But again, not an emergency. Also, higher interest rates tend to harm certain stocks, especially those that have debt. So a lot of times smaller companies where they have to get their own financing, their debt costs are going to increase. Whereas a company, say like, Apple or Microsoft, they have some debt, but it's not burdening them really. So that higher interest rate's not a big cost for them, especially because their credit rating's so stinking high. So those companies aren't going to be as impacted by it. In fact, they might benefit because some money might turn more their way seeking safety versus the smaller companies might get hurt in the short term because now their borrowing costs have gone up. So lots of different ifs and different ways that it could impact stocks. Just know it's not an emergency. Maybe it's a bigger deal long term if interest rates continue to rise or if the economy turns down. So there's lots of things that could happen. But whenever you see the news going crazy because the 10-year has gone up to whatever percentage, don't freak out. It might have a short-term impact on your stocks. But if we're structuring this properly to where we have the individual bonds set aside for at least 5 years of cash, which we talk about all the time, and then we have the stocks focused more on the long term, the 5-year plus, 5 years, 10 years, 20 years, long-term investments. These short-term changes in interest rates really are not a big deal at all. In fact, they're actually a help to retirement planning because now those bonds that you're using for the next 5 years of cash are paying out even higher interest rates. So for retirees, most of the time, it's a good thing, and certainly no reason to panic at all.
Thanks so much for tuning into this episode. I really appreciate your support and hope you found value in the conversation. If you enjoyed it, be sure to subscribe, leave a review, and share it with someone who might benefit from it. Your feedback helps keep the show growing. Until next time, take care and stay strong as we learn to retire with peace.